All right, hi everybody. My name is David Gully, and I'm at Bentley University, and this is March 17th, 2020. And this is another monetary policy update. So thank you for joining us. Just remember, we have a YouTube channel, Bentley University EC391, that contains a whole number of really helpful videos. So what I want to do here is to cover some interesting stuff that's been happening. Let me see if I can get my screen going here. There we go. All right, so since January 2020, when I did the last update, the coronavirus has had a pretty material impact on world economies and financial markets. For example, supply chains have been dramatically affected, and this has reduced short-run aggregate supply. There's been a gigantic increase in uncertainty in the current and the future state of the economy, and this has acted to reduce aggregate demand. Various government actions, travel restrictions, quarantines, and things like this have reduced both aggregate demand and short-run aggregate supply. And then on top of that, we have an oil price war between the Saudis and the Russians, though that does work to tend to increase short-run aggregate supply. But still, the net impact is we're going to see reduced GDP growth, probably recessions in many, if not most countries, and substantially lower inflation with a possible maybe even risk of deflation. And this seems to be happening very quickly across many countries at the macro level. Okay, so we can see this in the aggregate demand, aggregate supply model. So if we have inflation on the horizontal axis, excuse me, the vertical axis, we have real GDP on the horizontal. We have the long run aggregate supply curve here, remember, which gives us our maximum sustainable production capacity. So we'll label that Y star. We have our short run aggregate supply, and then we have our aggregate demand. And so, for example, the supply chain interruptions and the business closures will tend to shift the short run aggregate supply curve back to the left like so. But then the uncertainty, the declines in consumption and investment, those things will tend to work to decrease aggregate demand. And so probably the net impact by far is going to be to see a reduction in the inflation rate. See, make sure I get this right here. Yep. A reduction in the inflation rate. And then what's critical here is a decline in real GDP. So you have a lot of things going on to affect both the demand and the supply side of the economy. So financial markets, unsurprisingly, are feeling a lot of strains here. I have some graphs in just a couple of minutes. We've seen dramatically lower equity prices across most of the world. We've seen lower nominal and real interest rates on riskless assets. And what was interesting is that initially long-term treasury rates plunged even lower than where they are today right now, and then increased because what happened is people moved out of, or initially moved into treasuries, which were viewed as safe, and now to some extent are moving out of treasuries and into cash because that's viewed as even more safe given the current environment. But we've seen, however, higher nominal and real rates on risky assets. And again, I got a visual on that in just a minute. And we've also seen substantial strains in short-term lending markets. The idea here is that financial institutions are tending to reduce their willingness to lend to other financial institutions. So in short, the plumbing of the financial markets is starting to experience some pressure here. So the overall problem here is we've got a lot of uncertainty and we have a lot of volatility. And so if you look at how central banks talk about this, they talk about it in terms of financial market conditions have tightened. That's typically the language that they've used here. So some equity prices falling. So even today, the S&P 500 fell, very nearly 12%. That's a big move in a single day, of course, and that's on top of all the losses we've had recently. We have treasury yields declining dramatically. This is the 10-year rate, which is a standard benchmark rate, not just in the US, but in a lot of the rest of the world. And you can see that as recently a month ago, that interest rate was over 1.25%. Just a few days ago, it reached well below 0.5%. And right now, we're hanging around just about 0.75 percentage points. So very, very dramatic drops as market participants have moved into looking for safety. But on the other hand, relatively risky debt interest rates have increased. And so this is the interest rate on BBB bonds in the US. And BBB is actually an investment grade bond. But even still, notice the dramatic increase in yields on just those. The increases in junk bonds, even lower rated bonds, the interest rate increases have been even more dramatic. right? And so what happens here is that economic stresses are showing up and affecting financial markets. So for example, as businesses see lower cash flow, that makes certain business debt more risky. Consider, for example, the travel, tourism, and hospitality industries. They're seeing their cash flows fall dramatically, and that might affect their ability to service their debt. Likewise, oil too. Oil prices falling dramatically. That is going to impact their ability, oil companies' ability to finance their debt. The general uncertainty pushes up risk premiums and liquidity premiums. Liquidity premiums are a premium that bond holders or debt holders have to receive in order to be safe from the possibility of not being able to sell their security when markets go sour like they are now. So these liquidity premiums are rising dramatically. So as I noted already, junk bond rates are up. There's a flight to quality that raises overall credit spreads. In other words, the difference between risk-less assets and risky assets. And what's starting to happen is that some businesses are starting to have trouble refinancing their debt and also borrowing to fund their operations. And then finally, all companies may or even already are having a harder time raising funds. And the idea here is that this is going to affect even their day-to-day operations, let alone their long-term plans here. So the point here is that news on the economy affects financial markets, and that there's more uncertainty here in the issue, with all the issues going on. And so as a result, financial market, most asset prices have been falling. But it also works the reverse. Financial market stresses filter back into the broader economy. So for example, consider lending institutions. If they pull back lending, that's going to reduce aggregate consumption in the economy and aggregate investment in the economy, and that will tend to reduce aggregate demand even further. And it also has a supply effect in that if banks aren't lending, that tends to reduce the ability of firms to supply output. Already mentioned, we have the short-term stresses in the funding markets, and to the extent that this is happening, firms might be limited in their ability to fund even their day-to-day operations. There have also been some problems in the liquidity in the treasury markets, and this is very unusual. Mostly the treasury markets are highly liquid in that it's very easy to buy and sell treasuries. And a lot of the markets here have seen dramatic decreases in liquidity, especially what are called off-the-run bonds. Off-the-run bonds are, for example, the current 9-year, 9-month treasury note, as opposed to the current 10-year treasury note. So the 9-year, 9-month note was issued 3 months ago. That liquidity of that bond is dramatically lowered compared to the on-the-run bond, the current 10-year. So these markets have seen dramatic slowdowns in trading. And then also, again, there's this feedback loop. So you have news on financial markets that affects the economy. The economy in turn loops back and affects financial markets. So this is a negative feedback cycle here that we have going on. So what's the Fed done? Well, they've done a bunch of stuff. So initially, they just talked that, well, maybe if need to, we will act. So their verbiage they used, this is only from a few weeks ago, Chairman Powell said, well, we will act as appropriate to maintain the expansion. Well, so at some point, words became not quite enough. So just not even 2 weeks ago, they said, gosh, we're going to cut the federal funds rate range by 50 basis points. And that was a pretty dramatic move and came relatively surprisingly. And so financial markets then were wondering, well, gosh, are they going to do anything else? And of course they did. So on March 11th, which again seems like a long time ago right now, they upped their daily repo operations up to $175 billion per day. In repo operations, we have another video on this. This is the January update that discusses repo operations in more detail. It's effectively short-term loans that the Fed provides to financial markets using treasuries as collateral. And they did this after they started ramping down those operations after the September 2019 issues in short-term funding markets. And then late last week, they announced that they were providing additional liquidity to financial markets, a total of $1.5 trillion in repo operations, $500 billion of 1-month repos, and $1 trillion in 2 separate 3-month repos. These are funding operations that were designed to provide a little bit longer term loans. And then even just today, they announced an additional $500 billion in overnight repos. So they continue to do more and more things here. And so then what we had is we had the sort of the big bang last night, is they did a whole range of maneuvers here. So this is very, very dramatic. So let's follow along here to see what they did. So they cut the federal funds target range to 0 to 0.25%. So they moved down to the 0 lower bound here. So this is the ZLB that the Fed finally lifted off from in December 2015. And they've pledged to do this until the economy has weathered recent events and inflation is back to around 2%. And I'll have more to say about that in a few minutes. And so what they did here in order to operationalize that, they reduced the interest rate on reserves to 0.1%, and they reduced the interest rate on the overnight reverse repurchase agreement rate down to 0%. Now we have videos to explain exactly how these work, but the idea is that those are what are called administered rates, and those administered rates, as the Fed raises or lowers them, pushes either up or down other short-term interest rates. And so by the Fed lowering these administered rates, that's going to push down other short-term interest rates as well. And just as an aside here, given that now that the ONRRP rate is 0, that use of that facility will be pushed down, probably down to about 0. They also undertook a bit of forward guidance in recent last couple of years. They backed off of forward guidance. They may now need to move back into that realm of policy action. So the committee expects to maintain this target range until it is confident that the economy has weathered recent events and is on track to achieve its maximum employment and price stability goals. So the idea here is maximum employment and price stability. The Fed has a dual mandate that by law it has to achieve the best sustainable employment it can do and price stability. Now they've defined this as trying to hit a 2% inflation target. So they're trying to tell us that they're not going to pull away all this accommodation until things are a lot better. And what's the idea here of that is if you can push down the expected future path of short-term interest rates, that'll help further reduce long-term interest rates. And so the idea here is what the Fed is trying to do is it's trying to work through, whoops, can't spell very well here, to work through the yield curve. And then they did some things that were very interesting here, 2 of them. They reduced the discount rate down to 0.25%, and they encouraged banks to borrow, and they did so and said, gosh, you can borrow up to periods of 90 days. Now, generally, the discount rate, which is the interest rate that the Fed charges banks to borrow from it, that is typically kept well above the federal funds rate, the interest rate that banks charge each other to borrow, so that banks don't go to the Fed on a day-to-day routine basis. The Fed wants to act as a lender of last resort. That's its typical traditional way it's operated the discount window. What they've done now is they've reduced the discount rate down to effectively the top range of the federal funds rate, and they've actively and openly encouraged banks to come and borrow, but it's unclear whether banks actually will, and I'll have a little more to say about that in a few minutes. They also cut the required reserve ratio on checking accounts down to 0. So the last time the Fed did anything with reserve requirements was all the way back in 1992. And the idea here is that they're sort of suggesting to banks that now you have a few more reserves to lend out, though in this respect, I probably don't think that's going to be particularly effective, though it might act as a signal of the Fed's commitment to pursue an expansionary policy. And I've got a good visual on this here in just a second. They've also worked to coordinate with a number of other central banks, the Bank of England, the Bank of Japan, the European Central Bank, the Swiss National Bank, and the Bank of Canada to offer what they call dollar swaps. The idea here is that a lot of business is done in dollars in the rest of the world. And in periods like this, the dollar being a reserve currency, there's an increase in demand for dollars around the world. And if dollars run scarce in the rest of the world, that might affect the plumbing of world financial markets in terms of its proper functioning. So what the Fed is doing here is they're promising these other central banks that they'll provide as many dollars as they need. And the way they do this is they will swap or trade dollars for the various foreign exchanges here. So the ECB, for example, can swap euros for dollars with the Fed. And then now that the ECB has more dollars, they can lend those out to their own banks so that those banks can meet the dollar funding needs. So this is the idea here, is to keep the world's financial plumbing working. They haven't called it yet this, they've also started QE4. So what they're doing here in central bank language is they're engaging in another large scale asset purchase. And they're a little bit vague on this. They've said they've started out at least at $500 billion, or excuse me, $700 billion, $500 billion in treasuries, and $200 billion in mortgage-backed securities. So this $500 billion here, that's in treasuries, and the $200 billion is in mortgage-backed, and that's at least those figures. So it is entirely possible and very likely that they're going to be increasing those values. They've also pledged to not let any more mortgage-backed securities run off their balance sheet. The idea that they have been recently doing is they've been letting mortgage-backed securities mature and fall off their balance sheet, and they were replacing those with treasuries. So they were substituting more treasuries, fewer mortgage-backed securities, and they've stopped doing that. They've also suggested that where they're going to buy these treasuries, the verbiage they use is across the curve, meaning all the way from short-term maturities all the way out to long-term. And they've also done something that I find particularly interesting, is they've encouraged banks to draw down what they call liquidity buffers. And so this is from a statement that they released last night. U.S. bank holding companies have built up substantial levels of capital and liquidity in excess of regulatory minimums and buffers. And these are from Dodd-Frank and other acts. The largest firms have over $1 trillion in common equity and very nearly $3 trillion in highly liquid assets, for example, like treasuries. And so what they're trying to do, the Fed is trying to encourage financial institutions to lend these out or to make these available. It's unclear whether they will actually do that, because in a time of economic and financial uncertainty like we have now, banks, like lots of others, become more risk averse. And so they might view the equity and the high quality liquid assets as sort of insurance policies. And so it's not clear whether the financial institutions will actually follow through on what the Fed wants. And the interesting thing here is that what the Fed is trying to do is to create what's called a counter-cyclical capital buffer. The idea here being is that when times are good, banks build up their liquid and safe assets. And then when times go bad, these are released to allow banks a cushion to maintain or even increase lending. And so what they're trying to do here is to stabilize liquidity over the business cycle rather than acting in a pro-cyclical fashion, which has historically been the case. So what we can do is we can see this in the market for reserves. Now we have a whole series of videos on the reserves market. And so let's illustrate just a few of the things that are going on here. So what we have on the vertical axis, we've got the federal funds rate. And on the horizontal axis, we have the quantity of reserves. And let me just explain these curves quickly here. Again, we have a whole series of videos that explain these. This really odd looking curve right here, that's right here, that kind of looks like a demand curve is in fact the demand for reserves curve. So this is the demand for reserves here, demand for reserves. And this vertical portion right here, that is represented by, or gives the minimum required reserves in the entire banking system. And by eliminating reserve requirements, what the Fed has done is effectively gotten rid of that horizontal part there. In other words, now there's no minimum required reserves in the banking system. Now, granted, that wasn't a very binding constraint right now, so that might not have very much significance more than being a signal of the Fed's commitment here. We also have two other parts of the demand for reserves curve. What are most interesting here was that we have the interest on reserves and the ONRRP rate. So I mentioned earlier, these are called administered rates, and the Fed will move these up and down to move up and down short-term interest rates. So what the Fed did yesterday is they pushed the IOR rate, and then the ONRP rate actually went down to 0%, and the IOR rate went to 0.1. And so they're trying to push down overall short-term interest rates, including the federal funds rate. Other things they're doing here, so we've got a whole lot of action, is this very odd curve right here, given by what looks like to be an upside down L, is actually the supply of reserves curve right here. It's got a vertical part and a horizontal part. The vertical part is given by what's called non-borrowed reserves. And what's happening here is this is controlled by open market operations. This is the Fed buying and selling securities. And so when the Fed is now undertaking its now QE4 by buying treasuries and by buying mortgage-backed securities, it's increasing the supply of reserves in the banking system. When it increases the supply of reserves in the banking system, it shifts this to the right. So it's increasing the supply of reserves, it's increasing and improving liquidity in the banking system. And then one more quick thing here is by lowering the discount rate, what the Fed did is it took this horizontal portion right here. This horizontal portion is traditionally well above the actual federal funds rate. And so this is the discount rate. But now what the Fed's done is it has pushed this all the way down to 0.25%. So in other words, it's just right at the top range of now the federal funds rate. And as we said earlier, what they're trying to do is encourage banks and other institutions to lend to businesses and lend to the public. So how come they're doing all this? Well, this is what they seem to think is appropriate to deal with the economic and the financial market conditions that exist right now. So on the announcement of this last night, the futures market rose very dramatically. The idea being, well, the Fed has come to our rescue, we're all saved, and so we should run out and buy, and futures markets skyrocketed. But that skyrocketing didn't last very long because then they wondered, well, gosh, why did the Fed act so dramatically? Why did they do QE4? Why did they lower the federal funds rate to 0? Why did they cut reserves down to 0? Why did they lower the discount rate? Why did they do all the things they did yesterday? What do they know that we don't? Gosh, maybe we should sell, because consider this. This is a headline I pulled today from CNBC. Dow plunges 9% even after emergency Fed rate cut. Trading briefly halted after the open. The circuit breakers kicked in just right after the opening today. And notice the language, even after emergency rate cut. You could replace that language by, not despite, but because of. So in other words, what's happening here is the Fed might be signaling that it's seeing very bad things coming. And if they see very bad things coming, maybe financial market participants got in their heads that, gosh, we maybe ought to sell. So what they're trying to do here is to maintain compliance with their dual mandate. So they are required to do this by law. And so the Fed is clearly very concerned with the employment and GDP portion and also inflation falling below their mandate compliant levels. So what will the impact be? Well, it's really too early to know here, but we can say a few things. The most important things the Fed can do right now is to maintain public confidence that the economy and financial markets are going to continue to work. Things are going to get more difficult here, to be sure, but as long as there is at least some confidence that the financial markets aren't going to implode, that the plumbing of financial markets will keep working, at least that there's a chance that at some point a recovery, once the coronavirus issues get taken care of, the recovery can take hold. And so what the Chair Powell in his press conference said yesterday is wants to maintain the flow of credit throughout the economy, not just the US economy, but also the rest of the world. And in his press conference, Chairman Powell also admitted it will take a toll and did admit that the Fed's actions certainly are no cure-all here. And the idea what he's trying to do is make sure markets function. In other words, buyers and sellers can match up with each other. He's not trying to protect prices or anything like this, but the key thing is he's trying to make sure financial markets work. So his press conference, just taking a few snippets from there, and we said, must do what we can, and what he's trying to do is promote a swift return to normal again once the coronavirus gets under control. He specifically noted, as we mentioned earlier, the travel, tourism, and hospitality industries. Mentioned that U.S. exports have been negatively affected by foreign economic conditions. He also noted the energy industry. We've got the Saudi-Russian conflict here, which is pretty interesting timing in this situation. He noted that inflation is being held down, and again, in central bank language, tightened markedly financial conditions have. He's also said there's been a lot of signs of stress in treasury markets and short-term markets in general. and that these can reverberate and impact the rest of the financial industry. And what he's trying to do here, and again, these are his quotes here, a more vigorous recovery once the coronavirus is at least reduced here. He offered also, he promised to use the full range of tools here. We'll talk about some other stuff here in a minute. He said that fiscal policy might have a substantial role in promoting the recovery because it can reach, again, this is his verbiage here, it can reach people directly, whereas it's much harder for monetary policy to do this. He explicitly said they are not looking at negative interest rates or expanding the types of assets that they purchase with QE. Again, key qualify here, not yet at least. He does think, and again, I got to talk about this here in just a second, they do have more of what policymakers, what central bankers call policy room. In other words, the ability to pursue a more expansionary policy if needed. And just a quick aside here, they had a meeting that was scheduled for Tuesday and Wednesday of this week. That is off. The information they provided yesterday sort of replaces this. And the interesting thing here is the fact that they moved the meeting up by just 3 days, suggested they didn't even want to wait a few days to make these dramatic moves. And it's possible that financial markets also looked at the fact they didn't even want to wait 3 days as a negative signal of how bad the Fed thought the financial markets and the economy were going to be. They also are not going to print, at least for March, or publish, at least for March, the summary of economic projections. This is where they make their forecasts of the federal funds rate, GDP, and inflation and unemployment over the next couple of years, because he said there's just too many developments going on. And he said that we can expect this again in June. So it'll be pretty interesting to see what the Fed thinks in June about the future state of the economy. So can the Fed do more? Yes, it can. So it can increase the size, and it can also increase the length of QE, so it can add more liquidity to the financial system. They can also do more with forward guidance. So they were a little bit vague, the Fed was, with exactly when and under what conditions they would start to back off some of these expansionary policies. One thing they could do is they could commit to pursuing this policy until actual inflation is above 2% for a while. And there's different verbiage that they could use to get this across. But the point here is they would want to commit to getting inflation not just back to 2%, but actually above 2%, so that over a period of time, inflation would average 2%, in other words, right around the Fed's target. They could invoke sections 13.3 of the Federal Reserve Act. This allows for exceptional and exigent circumstances to authorize actions beyond its standard policy tools. So interestingly here, the ability of the Fed to use 13.3 acts or 13.3 behavior has been reduced pretty dramatically by Dodd-Frank. The general restriction is that the Fed can't bail out individual financial institutions. It has to offer what are called broad-based lending programs available to lots of financial institutions that can put up sufficient collateral. They could also, and I expect to see this coming actually maybe relatively soon, resurrect what's called the term auction facility, where the Fed auctions off funds to banks and other financial institutions, and also the term securities lending facility. And what they do here is effectively they are auctioning off or making available their stock of treasuries to financial institutions who can then use those as collateral for their own operations. And these are two policy tools that were used during the financial crisis back in 2008, 2009 to some good effect here. So again, there's a chance the Fed might use these. They might need to do this because remember just a few minutes ago we said, gosh, what they've done, the Fed has, is they've encouraged banks to borrow from the discount window. Well, they did the same thing in 2008, but banks did not take them up on the offer. And so this is why the Fed went to the term auction facility to get the liquidity into the hands of financial institutions. All right, so thank you very much, and that's all we've got here for today.